Hey everybody, how are you? This is Mark Fuller, Manager of Wealth. Just wanted to come to you real quick and talk to you about a subject that I don't think a lot of people are up on. I wanted to talk to you a little bit about what's going on in the mortgage market. In particular, if you saw the articles this morning, the numbers of people applying for forbearances. Forbearance is basically your lender agreeing to allow you to rearrange your mortgage. In this particular case, roll on the payments to the back of your mortgage. A forbearance, which is in this particular instance seemingly innocuous, is going to have a number of long-lasting implications on borrowers that people are not talking about. The number one thing that people are not talking about, if you so choose to not pay your mortgage and roll the debt onto the back of your mortgage, whether it's one payment, 3 payments, or 6 months, whatever your bank allows, you are now in what is called a forbearance, which is them allowing you to change the terms of your contract. Per underwriting guidelines, if you are in a forbearance, it is just like if you ever had a foreclosure. You will not be able to get financed in a conventional or a government loan for 36 months after that forbearance is closed. Now, why that's important is that a lot of people do not understand what a forbearance is. So the way the government has set it up is that your credit will not be affected by rolling those payments on to the back end, but your mortgage payment history, what's going on internally in the bank, will be affected. And when you go to refinance, even if you have an 800 credit score, have the income and assets and a ton of equity, you could have a $500,000 place with a $200,000 mortgage, and you could say, oh, I want to pull $50,000 out. Well, the underwriting guidelines for the mortgage that you are looking to get, you will not be able to qualify for that mortgage regardless of your credit score and equity position, because the guidelines say that you have to be at least 36 months out of any forbearance or foreclosure. So you're functionally being cut off from your equity. So please bear that in mind before you make that decision, that you are being functionally cut off from your equity. The other thing that you need to be aware of is the more people that take advantage of this program, the tighter all the lending guidelines are going to get, and the higher interest rates are going to go. And I'm going to talk about interest rates and the opportunities in the market in another video. But I just want you to understand, the banks are a business. If that business has a ton of customers that are not paying, and the rates right now are skyrocketing of people who are calling, again, I told you, just between March 30th and April 1st, the numbers of forbearances went up in that 3-day period 2,000%. So please move very carefully, because you will be cut off from your equity, and the only way to gain access to your equity would be to sell your property functionally. No matter how good your credit score is, no matter how high your income is, if you're in a forbearance, you are cut off from refinancing and getting any type of financing if you can't even get a line of credit, because everybody's underwriting guidelines say very specifically you can't be financed in a forbearance, and you have to have closed out that forbearance before you can even be considered, and it's 36 months after that date. So if you roll in these payments and you think you're going to pay it off at the end of the mortgage, then between now and the end of the mortgage, you'll be in a forbearance the entire time, okay? If you pay the mortgage payments back, a year from now, it'll be a year from now and 36 months after that before you can do anything structurally with financing that property and getting a mortgage from any lending institution. All right, just wanted to drop that in your ear. My name is Mark Fuller with Manager of Wealth. If you have any questions, please feel free to hit me. Take care. Bye-bye.